All right, good morning, everyone. Welcome to day 2 of Cloud Next. My name is James Lee. I have the pleasure of running our startups and AI business. And as part of that role, I've had the pleasure of working with the investment ecosystem with a lot of investors, early stage, growth, et cetera. And one of the perks of working this role is I really get to work closely with the alphabet investment funds and get an inside look on how they think about investments. So today, I am very excited to be joined by my 2 friends, Crystal from GV and also Bruno from Capital G. And I find this to be a fascinating combination because GV is typically a more early stage investor, and Crystal also comes more from the investment side of the house. And Bruno's from Capital G, which is more a growth equity fund. And Bruno also happens to be leading the portfolio management team. And we're going to hear a little more about how the 2 of them think about investment to due diligence to actual portfolio management. But before we do that, I wanted to also say a few words about their backgrounds. And given both of them have illustrious careers, I'm going to pull out my phone to make sure that I don't miss anything from their background. So Crystal is a general partner at GV. And Crystal, I believe you specialize in SaaS and infrastructure and fintech, Gen AI as well. So pretty much everything that's hot under the sun these days.
Not crypto.
Not crypto, yeah. Whew, you dodged a bullet there, yeah. Before GV, Crystal was an investor at NEA and GGV Capital. She partnered with companies including Attest, BigCommerce, BitSide, Brightwheel, et cetera. The list goes on and on. It would take us forever to call out all your portfolio companies, but obviously you've been just a very stellar investor. Crystal grew up in Vancouver, Canada, just like myself. Thought I'd do a little plug for those who have not visited Vancouver, Canada before. It's beautiful. She graduated from Harvard University with a BA in government. And wow, you even found time to enroll in a master's in computing and information technology degree program at University of Pennsylvania. So I guess that's happening in parallel with your work right now. So welcome, Crystal. Bruno, Aziza, he is a senior operating partner at Capital G. So Bruno, for those of us who are coming from more the B2B space, he's probably no stranger. He has been a seasoned executive focusing on high growth SaaS and enterprise software. Before joining Capital G, he was working at product management at Google Cloud. He helped grow the data and analytics business by 5-fold. So we'll have to talk about that. That's even for Google Cloud, that's a pretty amazing statistic.
Interesting ride, yeah.
Right. And in less than 3 years, Google Cloud became a top 5 enterprise software company adopted by 60% of the world under your watch. Thank you, Bruno. And today, you lead product, marketing, sales, business development teams across basically your entire Capital G's portfolio companies, right?
Yeah.
So you have an inside view on a lot of these things. And Bruno was educated in France, England, and Germany, and also a soccer player.
That's correct. And I'm realizing if you 2 are Canadians and I'm French, maybe we should do the rest in French, right?
Oh.
Make it entertaining for people. I'm noticing the translation. At some point it said I was a dead entrepreneur. So I'm confirming I'm not dead yet. One fact you forgot about my bio is I think I might be the only person in the room whose last name reads forward and backwards the same way. So that's an easy way to find me after this.
Yes, yes. Well, that's great. We're very excited to have both of you. I think many of you are here today because you want to figure out, many of you are founders who are trying to figure out how to get to the 100 million funding round. And today I think our aspiration, our objective is really to what I call demystify a little bit what happens behind the scenes, right? Like how do investors think about companies that deserve a certain valuation? How do you think about the due diligence process? What are the things that stand out in a positive manner? What are some of the red flags? How do you position yourselves as founders, startups, to be in the best footing with investors? And so we're going to cover some of these topics. And then we're also going to talk a little bit about once the investment is gotten into your company, like what can you expect from the investors, especially, Bruno being from the operational side, talking a little more about how they can support your business to transform it. So I call this Investment 101 Mythbuster Edition. So with that, why don't we start with something a little bit non-generic, just a little bit different, just to get the crowd going, right? Instead of asking the two of you about, what are the trends that you're interested in, why don't we talk about some of the things that you disagree with, like specifically, what are some contrarian views that you feel like might be not in line with what the market is thinking, but something that you hold. Why don't you start, Bruno?
I'll get us kicked off. First of all, I'll answer the whole thing. What's exciting right now, if you're in data and AI, and I'm a data guy, is that you have an immense opportunity to create value in ways that we didn't have before. Before people thought about data as a liability for the organization, you're all sitting in a role now building applications to drive bottom line value for your companies and your customers. The contrarian view that I have is really based on what I've witnessed, helping scale companies is, I'll give you two and maybe we can debate them. The first one is, it's not always the best product that wins. And the reason for why I'm saying that is if you're a technical CEO, and I've worked with technical CEOs and sales and marketing CEOs as well, you have to think about the whole product. It's a concept that was popularized by Jeffrey Moore. And it's this idea that it's not just the bits that matter, it's what's around the bits. And so you have to think about distribution, the services, and so forth. And then finally, as you scale, the contrarian view that's helped me a lot is you don't just build for yourself. Often when you start a company, you're going to build it because you have empathy with the product and the problem itself, and you're solving for something you've experienced. But I think as you scale, you also need to build the humility to understand that the customer is the customer. That's who's going to pay for the service. And so managing that transition as a founder is often challenging, particularly if you're starting as a technical founder. So those two things, hopefully we get to debate them a little bit, but I think they're fairly contrarian because they're counterintuitive, right? It's not always the best product that wins, and you're not always just building for yourself.
Crystal?
Yeah, I spend a lot of time investing in sort of the Gen AI ecosystem, so I can speak to kind of business models. I've been spending a good amount of time looking at LLM-powered services as an opportunity. Before LLMs, it was pretty out of favor, I would say, to invest in any kind of tech-enabled service platform. So, 5-6 years ago, there would have been tech-enabled law firms, tech-enabled accounting firms, home services firms. And a lot of those companies came out and raised money and said, we're going to be 10x as efficient because we use technology. Well, how it turned out was that they put a website up and they had an online booking system and they used tech internally, but each individual human was not 10x more productive. And so many of those businesses didn't scale to be, sort of big software outcomes. And so I think VCs tend to not very much like that kind of play. And I think now, with LLMs, there's the chance to break your time allocation and the economics of those businesses and make them a lot more efficient and truly automate a lot more workflow. And I think if the market is big enough, even if you have to worry about like public market exit valuations, you could actually still imagine a pretty big outcome and good venture returns. So I think that's a little contrarian, which is we're not afraid of services businesses getting more efficient over time, whereas that was out of favor.
Very, very well said. Maybe just as a follow-up question, is there an area that's a little bit what we call under the radar innovation that you feel like maybe a lot of mainstream investors are missing? Maybe Crystal, you can start. Yeah.
Sure. Probably that space that I just talked about, right? Maybe another that I think there'll be a lot more activity going forward is just like alternative hardware and processors to create more like diversification and competition in kind of the training and inference hardware world. I don't know that's a controversial thing to say here, but it's, there's opportunity to have a lot more players be suppliers, right? And opportunities to imagine if the models change and if it's not just transformers, if it's other architectures, what type of hardware is ideal for those types of models and approaches, and should those be new companies? And so we're investors in a company called SambaNova, which is like an actual new chip company with a whole sort of ML development stack on top. And so I think there'll be more of those in the future.
Great.
Yeah, I think, I'm a data guy, so I'm going to have a bias on data. And we were just talking about this before the panel. In the Gen AI space, we get excited about the new stuff. Right, everybody's excited about these new applications you get interact with. But I think, and we talk about context windows and size of the data, but I think the one thing that we tend to forget is in this technology transition, there is something like a wedding, right? There is something new and there is something old. And the new stuff is the stuff that allows us to engage with the business users, right? If you're in technology, now you got everybody interfacing with these applications. Probably the first time this happened in the last 30 years, where finally people care about data, AI, and analytics as a business user. But the thing that we must not forget is the old stuff is still very true. If you have bad data, if you have bad data governance, you now have built applications that give you the wrong answer very quickly. And so what we're learning from customers is that building a foundation that is built on strong data and AI governance is this underlooked, step that often costs organizations a lot of money after they've deployed applications. So we're an investor in an organization called Calibra, for instance, that specializes in AI governance. The reason behind it is because if you don't pay attention to the governance, you're going to have issues in getting in productions. The companies that don't get into productions Gen AI essentially have two issues: security access and then attribution and origination of that content. And so if you can't manage that well, anything you do above that layer is really going to be challenging. So I'd say governance is probably the most underlooked trend at the moment.
Absolutely. And that's actually a nice segue into something that I want to talk to you both about. My feeling or my observation today in the fundraising environment, it's a bit of a tale of two cities. So you have everything that's non-gen AI, which is really struggling to get any sort of traction and attention from the investors. Then if you have anything that has a .ai after it, then you shoot up to a unicorn immediately. I cannot tell you how many times I get approached by a company and they're asking for a valuation of 1 billion plus. And I ask them, do you have a customer? No. Do you have a GA product? No. Do you have a roadmap to profitability, to revenue? No. And they show me a couple of PowerPoint slides on why they're worth $1 billion. And so, especially in this environment, because things are so new and it's almost like you're making a big bet, right? And a very, very big bet at crazy valuations. The due diligence process takes center. Not that it wasn't important before, but just the way you ask questions and how you verify things become really important. So, Crystal, I wanted to maybe have you answer this question. Can you maybe just walk us through how GB thinks about due diligence, especially against this backdrop of just this craze around Gen AI? And what are some of the positive things that you look for, and what are some of the red flags?
Sure, good question. I would say we try to have a very prepared mind about different spaces. So we don't like to meet a company for the first time and be pressured to put in a term sheet a week later, right? I mean, we can do that, and I think firms got used to doing that in 2021, but we like to know a space and a founder for a very long period of time. And the benefit of that is if you're really close to the market and you're meeting many, many companies, then the next incremental demo doesn't necessarily dazzle you because you may have seen it before, right? And so I think I'm now hitting a point where if you get a lot of repetitions, you're always reading about new products, you're always looking at the demos, you're meeting a lot of companies, you start to get a sense for what's novel and what isn't, right? The first time I get pitched by really cool tech, I think it's amazing. The 10th time, a week later, I realize it's not that hard to build. And so there's a lot of just having reps, right? And then I would say we're very customer-led, so we spend a lot of time talking to enterprises, so CIOs, VPs of engineering, CISOs, like chief data officers, and just trying to understand what they want to buy. And not only what they want to buy, but how technical are they? What's the right positioning to sell to them, right? Because sometimes a very engineering-led story also doesn't resonate depending on who the customer is. So we're always talking to customers, trying to figure out what they want, and then trying to match that to how different companies are doing it. And so I would say a lot of sort of validation of need, validation of budget, meeting a lot of companies, and then trying to stay up to date on research innovation. So we don't read every paper, but we try to keep on top of what different research groups at the top universities are also kind of putting out.
Makes a lot of sense. Bruno, similarly, maybe in a slightly different angle, I know Capital G is a lot about growth, but it's also about transformation.
Yeah.
And especially given that, some would argue that we're in a little bit of a bubble right now with Gen AI, right? There's a lot of noise. How do you think about the companies that are built to last, right? What are the companies with the moat that, once the tide recedes, they're going to be standing around, they're going to have customers, they're going to be profitable.
Yeah. So I've had the opportunity to be involved in all three stages of growth: super early, pre-revenue, mid-stage going IPO, and late stage large organizations. And my observation is this moat term is a super overloaded term. Everybody's looking for the one moat. So I think back about business school, the 5 forces of Michael Porter, right? If you're familiar with that, and there's 5 types of moats and it's 5 forces. And what we've observed is that the moat is something that is not an or, it's an and as you evolve through the phases of an organization. So very early on, the observation is, what is your perspective that is radically different from everything else that is going to put you in a position of disrupting a space? So I think the moat there, and probably in an early stage, is going to be your perspective and your vision for the industry. And then as you move and you start building products, it's your ability to execute and create IP that's truly differentiated and is really clear to your unique differentiation. And then the third stage really starts becoming about distribution. And that's, remember when I said it's not about the best products that win it, is because I think these 3 components are essential to creating the whole product that's required in order to scale and to win. In the way you communicate, we often talk about the words that you say, but I think it also has a consequence on how you organize your organization. One of the organizations that's in our portfolio is CrowdStrike. It's an amazing product-led leader who had this perspective on cyber from very early on, and he's the CEO throughout all these phases, and he organized himself very differently. Early on, when they started their sales team, in fact, they incubated an inside sales team inside Capital G, it was really about hiring this evangelist type of salesperson. They were really talking about where was the industry going in the next 10 years. And as they evolved now, they got people that really were supported with technical resources. They could show the differentiation in the IP. And now, as a public organization, really becoming the Salesforce of cybersecurity and really embracing the ecosystem, they are hiring the types of people that think about being the architect of scale. That is when you focus around leveraging your perspective, your IP, into the distribution system that allows you to change the industry to your perspective. So I'd say the moat, I wouldn't just over-rotate on one. I think it's probably just a few components that, as you architect them throughout the journey of your organization, really makes you a generational organization. Now, it doesn't mean that you have to hire new people. It's just being conscious of the journey of the organization and grow your team, your organization towards that. I could talk for hours on this. So I think hopefully I've answered your question here.
Bruno, I really like your approach to it, right? Effectively, you're saying that, hey, you got to have a great product, right? But you need to have great distribution, and you have to have a great team. Yeah, that's a magical formula for building companies that last.
We always say it's the soft stuff that's the hard stuff, right? It's the people, the ability to execute as a team that is not more important than the product itself, but it could really tank a company if they don't do that well.
Sounds good. Now I'm going to move into a very important topic. And if you're a founder in the audience, take out your notebook, because this is the part where you really want to be taking some notes. It's all about how do you get ready for your first 100 million fundraising round. Crystal, let me start with you.
Pressure.
Are there some specific indicators that you look for that, hey, this startup, this company is now ready for this big round, and like 100 million people throw it around like, hey, it's a massive milestone. Like how does it differ from like a seed round or a Series A or a smaller round? Like how do you think about that?
Sure. Raising 100 million in most situations, unless I would say it's for a foundation model training company, because then you might even be pre-product in that phase, right? But for most companies, if you're ready to ingest $100 million, you need to have predictability and visibility into what that gets you, right? So at the seed and the A, it's not always clear how a dollar converts into an outcome, right? It's converting into engineering time and roadmap and maybe POCs, maybe a little revenue, but you don't have a formula, right? It's very hard to model out. Whereas once you get to a stage where you want to raise that much money, investors don't want that to go to zero, right? They want to know that there's some predictable output coming from that, right? And so I would want to see at that stage, if you hire 3 AEs, what do you expect to get from that, right? What is the ramp period, quota, what's the expected attainment, how much more revenue does that get you? If you hire 10 more engineers, what does that mean for your roadmap speeding up? Like a lot of those things need to be instrumented and kind of understood. Not perfectly, but you need to have shown that you're good at forecasting all of the different sort of levers in your business for us to be confident that you would make good use of it.
Same question to you, Bruno. I know you always carry your checkbook in your back pocket, right? They have 100 millions pre-printed on the check. So,
and one of you will get it today.
Yes, Bruno's going to be throwing them in. Yeah.
Look under your seat. Yeah, what's your number?
Yes.
Look under your seat.
What do you think, Bruno?
So, I'll answer as an operator, less as an investor, because that's my role at Capital G. The specific milestones that we look at, because we're very product and customer centric, is what is the evolution of your customer as they're adopting the solution? I mean, the one metric is adoption, right? And is also the best way that you can assess the potential of an organization. And adoption for two reasons. I think reason one is the ability of the target market you're going after, if it's the enterprise, to adopt the solution themselves, but also your ability as an organization to learn from that adoption metrics. Because often I think, what's unfortunate is that we're not doing a great job at learning the jobs that are being solved for the customer. So there's a theory I'd love to refer to called The Jobs to Be Done by Christian Christensen. He's a great author and a great professor who wrote The Innovator's Dilemma. And he talks about this idea that when we are selling a product, we're not really selling features. What we're trying to solve for is the job that the customer is trying to move past. And having a true understanding of the jobs to be done allows you to truly maximize your opportunity and provide maximum value to the customer. So we look for that ability throughout the journey of an organization, because that's how you really get to scale. If you're just going after one specific feature and trying to monetize that feature, that might be a limited view to look at how you can really have a disruptive potential for your organization.
Got it. Makes a lot of sense. Maybe on a related question, as we think about these larger rounds, many times it's not just single investor. You're looking at a syndicate, right? You're trying to mix and match and trying to find the best combination of investors to come in and be on your cap table. Crystal, what advice would you have for founders as they think about these larger rounds and, finding that right lead investor, but having the right combination of financial versus strategic versus, new money versus old money, et cetera?
Sure. I think we always say, it's the founder's discretion to figure out what they want, right? We always ask at the end of a pitch, well, if you had to construct a perfect syndicate with the perfect assembly of skill sets, what would you look for? And so I would say they first need to have a view of what their gaps are. So some people might say, I'm actually not very good at go-to-market. Like I really need a strong go-to-market leader. Some people might say, I need to offload the CPO role to somebody new now. I have to, sort of up level to do CEO stuff. So you kind of need to have a good sense for where your gaps are and what you don't have as a management team or exec team. And then, in the background, be kind of getting to know VCs and trying to figure out who slots into those positions, right? So that kind of optimization of like skill set to need is one thing. But I think the other is just who do you trust and get along with, right? Like who do you actually want to team up with? People joke it's like, easier to divorce a spouse than a VC. Right? So, sort of be very intentful about who you gravitate toward as a person, right? Whose values align with yours. And you can usually, if you're mutually interested in working together, convince the other VC firm to get to a construct that's exciting for you, right? So, and I think that those situations where you decide who you want, then you try to get them to do the deal you want to do is better than trying to force like 20 people to bid and then deciding later.
Mm-hmm. Bruno, I'm going to give you an opportunity to do a bit of a plug for Capital G. I know Capital G prides itself and saying that when you get our money, you not just get our money, but you also get this operational know-how, you get this expert network, et cetera. Talk about what founders will get when Capital G invests.
And I think it's great advice what Crystal is talking about, because when you think about the horizon of your organization, you got to think 10 years out, right? So the folks you're deciding to partner with are people that you want to have on board with you that are complementing the things that you don't know, but also think about it as the best friend. Choose the people that you're comfortable being challenged with. And that's one of the reasons for why people choose Capital G is because, first of all, many of us are former operators. We also former Googlers. So we have this affinity with technology and the enterprise. And we've also organized ourselves in the way that we don't just invest, but we also help organizations post-investment scale throughout Google and other channels. So a great example is we have a network of thousands of advisors inside Google that will lean into the organizations that we have invested in and help either get on marketplace faster, get introductions into customers, into GCP and Google customers. So we can really kind of lean into the G in capital G, which is for Google, even though we're an independent Alphabet fund. And so I think that's what I would look for. You know, I've done 3 startups and I've done a lot of rounds. I think the best investors that I've had on my board are people like that, is that one, they complement the things I might not be the best at, and they know the people who do. And I'm very comfortable having the challenging conversations where they're going to call me out, right? Because a lot of what's great about entrepreneurs is that we have this amazing belief that everything is possible. And it's great that we have that. And we also need to have people saying, well, like you said earlier, you know, might not be as disruptive. We want you to focus on something else. So that's kind of a differentiation for CapG. And it's also, I think, in general, a good rule to follow for any investor you should choose from.
Absolutely. I noticed both of you have used the word scale over and over again, and it's something that I hear from a lot of investors as well. And I want to maybe just switch gears a little bit and just hone in on this topic of scale, right? I want to talk a little bit about the law of scaling, especially against the backdrop of Gen AI. And when we talk about scaling, it's not just about economics, right? It's about your computational power. It's about, you know, your data sets, right? It's about, you know, how can you create a business that becomes more and more profitable with less and less effort. So, Crystal, maybe you can talk to the audience a little bit about kind of how you view the law of scaling, why it's important to investors.
Sure. I think you're talking about maybe how, you know, more data, more compute, training longer, more parameters seems to equal better outcomes, right? Maybe that. And so, but of course, there are diminishing returns and nobody has infinite amounts of money to spend. So how do you optimize against that, right, for outcome? I think that's kind of the question. And I guess when we're evaluating companies, I mean, obviously we have a preference for lean uses of capital, right? And I maybe try to back solve from, you know, ultimately in the end, if you aspire to go public or to get acquired by an existing company, your financials can't look too crazy, right? Because other people have to answer to either, you know, their investors or, you know, the public market will respond to you and punish you if you made an acquisition that's very stupid, right? And so you kind of have to converge on a business where the margins look interesting and good while you're still growing. And so I think we try to look for companies that can do more for less, right? And so maybe that's an open source model, but a very curated data set for a specific domain, plus like very, you know, easily incorporating the customer's data so that the performance is better and more personalized. Like we like those kinds of creative approaches because I think we don't have infinite amounts of money to give to companies to get like from 99 to 100, right? And a lot of the time for very domain-specific use cases, you definitely don't need the best general purpose model, right? You can actually have very good performance with fine-tuning or RAG. And so that's, you know, I think we look for people who are very creative around, you know, getting that done.
Got it. From a different angle, Bruno, when you work with entrepreneurs, how do they factor in scaling law, taking into consideration everything that Crystal just said, right? Yeah. Into their business and this concept of what unlock are you looking for?
Yeah, I'll be specific about the data AI space. There's probably a couple of things. The first thing is connected to what Crystal's talking about here is when we look holistically as the customer base, it's not like you go from just having a product and now you're scaling to these crazy use cases. Of course, more data and more computing is always better. But the reality is that you got to match to where the customer maturity stage is. And what we've observed for the market is there's essentially 3 phases that they go through on their scale as a customer. The first one is this phase called the data ocean. Everybody's been talking about data lakes and so forth. But the data ocean refers to this idea that we live in a highly distributed data environment where you need to think about the ability to live across multiple clouds and having a service that really is open, because it's fairly unrealistic to expect that all the data, all the models are going to be hosted in one place. And so having that as a construct allows you to help organizations mature beyond the data ocean. The second phase is that now you're putting the organization in an opportunity to create data products. This idea, this is why I was referring to governance earlier, is that where organizations want to mature to is data products, which is their third stage. But on the way there, they need to manage this very complex environment, having distributed data and distributed people, but still having centralized policy. So when people are enabled with data, they're able to follow the same policy that you've deployed. And then the third stage is this data product stage where you need to understand how the semantics of an organizations are working. And so when we look at organizations, we try to figure out what phase are they in, and are they understanding that they're not in the terminal phase, right? The overall goal, the job to be done for the organization is probably putting the organization into creating data products that drive bottom line value for their constituents. How do we get the products to evolve there? I mean, I know we'll talk about integration later, but a big core principle there is what is your choice in design? Are you an integrated platform vertically, or are you an open platform? And so there's determinations there because it can really reduce your ability to scale.
Very well said, Bruno. Well, Crystal and Bruno, thank you so much. This has been incredibly insightful for me, and I hope also very educational for the audience. In case you can't get enough of Gen AI, we've got a lot of other sessions for the course of this afternoon. There's one particular one I want to call out. We've got a fireside chat between Dario Amodi, who's the founder of Anthropic and a friend of mine, also with Elad Gil, who's a prolific investor, and Thomas Kieran himself will be joining the discussion as well. So that is definitely one not to be missed. Thank you for all your time today, and I wish you a really good experience here at Cloud Next.